Warm welcome to CA Raja classes and thank you so much for joining this mini and micro webinar. Before we get into the discussion, let me just take a couple of minutes to introduce myself. I am CA N Raja, a chartered accountant by qualification, a teacher and trainer by passion, and teacher for 3 lakh plus students worldwide. I started my career as a banker with State Bank of India. Then after a period of 4 years, I got into CA practice. I had my practice for 7.5 years. But I realized my calling is teaching. I started focusing on teaching and training, and today with the blessings of God, we have 3 lakh plus students worldwide. So now it's time for us to get into the session.
Let's understand the importance of debt to equity ratio from banking angle. Now, when we analyze this debt to equity from banking angle, we have to divide this ratio into two. One is the optimum ratio and the other one is threshold ratio. One is optimum, the other one is threshold. Optimum ratio is the ideal ratio which every company should be aspiring for, okay, whereas threshold ratio is the maximum beyond which no company should cross. That is, if the ratio touches this level, then it indicates that it is actually a danger line. Okay, so what is ideal ratio, what is maximum? Let's see one by one. The ideal ratio is 2:1. Okay, so what does that mean? When I say the ratio is 2:1, it means my debt is actually 2/3 of total funds and equity is 1/3 of total funds. So when I say 2/3 of total funds, it means my debt occupies 66.67. If I express that as percentage, it is 67% of total funds, and equity will be 1/3 of total funds, and it's going to be 33%. So this is considered as optimum or ideal scenario, okay, but it may not be possible in all cases, okay. Then let's see what is the threshold, that is maximum. The maximum for debt equity is something like this, 3:1. So what do we understand by 3:1? It means debt can be 3/4 of total funds and equity can be 1/4 of total funds. When we say 3/4, it means 3/4 and it is 75% of total funds, and 1/4 means 25% of total funds. So what do we understand here is, when we raise debt funds in our capital structure, at the maximum the debt can be 75%. At the maximum the debt can be 75%. It means equity should be at least 25%. The bare minimum of equity has got to be 25%. Okay, so if a company is going to cross debt level beyond 75%, then that is considered as danger. That's why the ratio greater than 3:1 is considered as dangerous scenario. Why it is considered as danger? Because at this level, this company has got lot of debt, that is 75% is debt. So anything greater than 75%, it means it has too much of debt. And what is the problem with too much of debt? You got to pay interest, you got to pay principal. Fine, that is associated with every debt, but you got to pay irrespective of what is happening in your business, whether you make profit or suffer loss. And it is not possible for a business to show only positive results all the time, because business operates in an environment where we don't have control over the macro environment factors. So if the macro environment is going to undergo a change, then your business may not be able to make profit, but whether you make profit or suffer loss, it is immaterial. You got to pay principal and interest even if the market is not doing well. So when you have too much of debt, you got to pay these, but you will not have resources to pay this. That's the problem. You will not have resources to pay these, so the people who have given this money will not wait for you to make the payment, but they would be demanding the payment. And if the payment is not going to be made promptly or even after giving some time, then that is going to bring a major risk. What is the major risk? It is possible that your business would become insolvent. Your business would become insolvent. You may not be in a position to pay. So the lender would approach court of law and they would say that they would request the court of law to close the business. Close the business, sell the assets, pay back loan. So that's the end of the game. So that's the implication if the debt equity ratio is going to cross 3:1, and that's why we call it as a dangerous position.
Thank you for watching this webinar. I am sure you have derived value from this webinar. And if you wish to learn more, I have some good opportunity for you. What is that? Check out.
It is this Credit and Financial Analysis Mastery course exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you it's just rupees 2499 for 1 year access or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over, you also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course you will understand what is working capital, what are working capital credit facilities and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis. Various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about about collateral securities, where you get knowledge about collateral securities. So overall, it's 15 courses of value close to 22,485. It's 1000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. And not yet over, you're also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.